Two growth stocks to buy into 2025. This is what this video is about. I found two very interesting setups in terms of growth stocks going into the new year. The first one I've never talked about before on YouTube. I'm researching it myself. It's a very interesting opportunity and I'm considering it for my own portfolio. I don't own it yet, but I'm considering it. Good setup. You're gonna like it, I promise. The second one is a stock I talked about many times. It's not Hims and Hers Health, but it's a hated growth stock, and I decided to do an update on it. So if you do enjoy it, if you want to help me out with the algorithm, press the like button and let me know what you think in the comments. If you like it, if you dislike it, let me know what you think in the comments. Okay, and before I get started with the growth stocks, I just want to highlight the way I think about them. And I did invest in many growth stocks before, Hims and Hers, SoundHound.ai, and many others. And the main thing with growth stocks is it's not much about the present, it's more about the future, because most of them are in early stages of the business cycle. So they're not focused on making profits, they're focused on growing, and they eventually get to making profits. Even Coca-Cola started the same way. Most companies, they go through the same cycle. So if you're investing in an early stage company through the business cycle, you're taking much more risks, but the reward is much, much higher. And the biggest mistake people make is they go and they put in their life savings into those growth stocks, and if they end up being wrong, they lose a lot of money. But the way I do it is I put in a small percentage of my portfolio in such growth stocks, because if it does work out, my gains are unlimited, but the pain or my losses are limited. And this is the way I do it, and this is the way I recommend you trying to do it in your own portfolio, but you could do whatever you like. Okay, now the first one is a very interesting one, and it's Meli, M-E-L-I, Mercado Libre. I believe this is how you pronounce it. It's down 13% on the month. Very interesting stock, very interesting one. And there's a lot of drama around this one. It goes up and it goes down. It has a very similar pattern. You know, it goes up and it goes down like 15, 20%. Then it goes up. Then there's some kind of news story. Then it goes down 20% on it. Then it goes up again. So there's a lot of volatility with the stock, even though it's a big company. It's very volatile. And a lot of you know what the company does. It's mainly in Latin America. And I'm actually very bullish on Latin America in the future. I have a few investments over there in Latin America. The demographics are amazing and the growth is only getting started, especially if you're talking about e-commerce, where Mercado does operate. And I believe Amazon is entering Latin America, and I have a position in Amazon, but Mercado Libre is 96 billion market cap. They operate in 19 countries. This is over 5.5 trillion in GDP and 600 million population. So the TAM is absolutely massive. And if you look at their market share so far as of 2024, 66.5% market share in Argentina. And a lot of you guys like the new president in Argentina, and they're changing it around. They have low inflation right now, and economic growth in Argentina is only getting started. So if you're trying to bet on Argentina, one way to do it is with Mercado. So that's a way to think about it. They have 33% market share in Brazil. This has been the weakest part of the business because Brazil has been struggling. The currency of Brazil has been very weak, and there's a lot of political uncertainty in the country, and it's been affecting the fintech platform of Mercado. And this is the main risk with the company, is the political uncertainty in Latin American countries. You might have a new president and he might switch everything around, and this is the main risk with those. This is why, you know, Meli is not trading at 100 times earnings. It's trading much lower than 100 times earnings. Okay. In Mexico, they have 21.7% market share. And there's some competition in many of those countries from Amazon entering and a few other competitors. And they are split pretty much half and half in terms of revenues. Most of it comes from the marketplace. So marketplace, third-party kind of products, retail, logistics, advertising, a lot like Amazon, and other kind of things, real estate and vehicles. Then I have the fintech platform, which has been huge. It has been rapidly growing in terms of investment, you know, payments, insurance, credit card, buy now, pay later, and, you know, many different kind of things. And 58% is e-commerce or commerce, and 42% is fintech. Fintech has been growing at a 70% CAGR. Total CAGR for the company has been 56% CAGR. The growth has been absolutely stunning for the company. And the growth could potentially be only getting started, you know, because if you look at the e-commerce penetration as of 2023 in Latin America, it's still only 13%. In the United States, it's 24%. In the UK, which I was surprised to see, it's 29%. It's over the United States. I wasn't expecting that. And China is 32%. So there's still a long way to go in e-commerce in Latin America. And if you look at the statistics in terms of banking, there's still a lot of cash being used in Latin America. And as less people use cash and more people use online transaction and online banking in Latin America, Meli could be a massive beneficiary of this trend. So they're riding an amazing long-term tailwind for the company. The fintech platform, monthly active users, 56 million, and they've been growing at a 32% CAGR. So it's a rapidly growing company. The last report wasn't too good. The growth wasn't bad, but the net income margin was a little bit lower, mainly because of some FX losses. Mainly the Brazilian real has been very weak, especially against the dollar and other currencies. It's been terrible. And they also were investing a little bit more in operating expenses, and it has caused a 160 basis point decrease in net income margin. And this is why net income margin went down. So it's more of a one-time thing. I don't believe this is something that's permanent, but the company right now should be more focused on growth than maximizing profitability. And this is exactly what the company is focused on. And this is what they should be focused on. So I like what the management is doing, and it looks very good. And if we look at the forward PE ratio, again, it's not trading at 100 times earnings. With such growth, it should be trading much, much higher if that was some kind of a US company or whatever. But it's trading at 46 times forward earnings. And I know for a lot of you guys, especially value investors, 46 times forward earnings is expensive. And I have to admit, it's not cheap at all. 46 times forward earnings, it's not cheap at all. This is a messed up chart, but it was trading much higher before because it was growing much higher. And if we look at the growth, it was $1.67 EPS gap. In 2021, it went from $1.67 all the way up to 2025 is expected to be $46.04. This is massive, massive growth on GAAP earnings per share. And it's expected to grow around 37 to 30% over the next 5 years. And I believe this is highly achievable for Mercado. It was growing 100%, 400% before, and it's just starting to get profitable. Revenue growth, I think 25, 30% for the future is possible. For earnings per share, easily above 30%. So if they do hit it, they could hit up to $112 of earnings per share, around in 2028 or 5 years from now. And I don't think this would be anything out of the normal based on the momentum of the company and how fast they've been growing. So, if you look at the PE ratio, 46 times earnings is not cheap for the political uncertainty, but for the growth of around 37, 38% for the future, it's not really too bad at all. It's just my opinion. Okay. Now, if we do just a basic valuation model, and instead of taking 46 times earnings, which I believe is expensive, we take $112 of earnings per share and 63 cents, and we time it by 30 times earnings, assuming they can hit $112, and that should be possible. 30 times earnings, this is around $3,378 per share. The current price is $1,725 per share. This is around 95% on the upside over the next 4.5 years with Mercado, and this is pricing in a multiple contraction from 46 times earnings to 30 times earnings. So this is, pricing in a decent margin of safety in terms of a multiple contraction. And this is pricing in, a decent growth of 37, 35%, which I believe is achievable. So on the low end, you could get 95, 100%. Best case scenario is it stays at, 46, 47 times earnings, which I wouldn't be counting on. So for me, looking at Mercado in terms of a growth company over the next 5 years, it looks very good. It looks very good for the company. Unless something major happens in Brazil or any kind of major political uncertainty that was unexpected or something crazy happens. I see a lot of upside for the company, and it's very risky, of course. All growth companies are risky because it's all about the future growth and not the present. You see what happened with the second one, Celsius. That's why I tell you guys, position sizing is key. You keep it a small percentage, and if it does work out, then you don't need much of it. But if it doesn't work out, then you don't lose too much. And the first one was Mercado. The second one was Celsius. Going into 2025, this one is very, very interesting. It's down 55% year to date. And a lot of you guys are familiar with Celsius and the product that they do. They try to market themselves more as a, healthier energy drink alternative with all kind of fruits and all kind of things in them and vitamins. And some people like them and some people don't. And the stock has been a disaster. The main reason why it's down 55% is because the growth has massively plummeted from 74% to 140%, all the way down to 3% for 2024. And the main reason why it went all the way down to 3% was because of the inventories with Pepsi. Pepsi has a stake in Celsius, and they ordered a lot of their products, and they overstocked on inventories, and they were trying to get rid of them. So they stopped ordering Celsius products, and it affected their revenue growth. And that's why it was only 3%. But based on the latest earnings report, and I talked about it before, looks like the CEO is getting more optimistic. And he did mention that it's nearing the end in terms of the inventory problem with Celsius, with Pepsi. And it looks like it's going to be getting much, much better from here. But not only the growth went down, but the multiple came down. The company used to trade up to 190, 200 times earnings. Now it's trading at 30 times earnings. Now, 30 times earnings may not be too cheap, but the stock also got much, much cheaper based on the revenue growth. So this is what's happening, and in my opinion, it's presenting a very interesting setup. The second reason why I believe a lot of that stuff is temporary and it's not permanent is because the company has very recently acquired a manufacturing facility in the United States. Now, if they didn't believe that it was temporary and it was permanent, why would they be increasing manufacturing capacity? Like, if they're not seeing more demand in 2025, why would they be acquiring additional manufacturing? Like, to me, it doesn't make any sense. And the management, they're not like some kind of stupid management. They grew Celsius out of nothing, and they took market share from Red Bull and Monster and all those companies. Celsius was unknown a few years ago. Now everyone knows Celsius. You see it all over in many different influencers. They advertise to Celsius, and you see it all over the place in all kind of stores and convenience stores and all kind of chains. So the management is not dumb. And for them to acquire more manufacturing capacity, that means they believe that whatever happened this year was temporary, and next year is going to be much, much better. That's the way I look at it. So this is another reason why I believe that it's more of a temporary problem, and it's likely going to get much, much better. Now, something else that I'm bullish on for the future of Celsius, mainly going into next year, is international growth. And if you look at the international expansion of the company, they just started expanding internationally this year. Like, they entered in Canada and the United Kingdom, I believe, in the first half, and Ireland, Australia, New Zealand, and France, I believe, in June, July, and September. So they haven't been there for too long, and they just got into them, and you're already starting to see results for international, 37% growth internationally. This is very rapid international growth. So we're already starting to see results. It's still a very low percentage in terms of total revenues, but it's going to grow over time. So next year, we could potentially have 37 to 40% international growth, and then United States growth could start picking up, into the second half of 2025, and that should push up revenue growth 15-20%, which means earnings per share growth should push up 20-25%. And this is the way I look at it with Celsius. And if they were able to take massive market share in the United States from 4.6% market share to 11.8% in just like 2 short years, why can't they do it internationally in countries like France and in places like Europe and Canada and other places? And this is where I believe most of the growth will come in, is in international revenue growth. And going into after the fourth quarter of 2024 into 2025, it's going to be a much easier year to compare year on year. And they should be growing in North America. International should keep growing. So I would see much better year in 2025. In terms of the way I'm looking at it, I put in for 2025, I put in 95 cents for EPS, which would highlight around 25% growth. And this is what the analysts are expecting for next year, is around 25% growth. And I can put up the chart. Now, assuming they hit 25% for next year, which is 95 cents, and I'm assuming from there that they grow 20% for the next 4 years, I would get around $1.97 5 years from now. Now, $1.97 earnings per share, and I'm timing it by 25 times earnings, which I believe 25 times earnings is very fair and it's not expensive at all, and it's much lower than 30 times what it's trading at. That would be around $49 per share. The stock right now is trading around $26 per share, and we divide it by $26 per share. This is around 89% on the upside over the next 5 years from here. Now, the main reason why I do such valuation models is because I'm trying not to overpay. So I always use the worst case scenario. So for Celsius, now it's trading at 30 times. If the growth picks up, could it trade at 40 or 50 times? Of course. 10 years from now could be trading much, much higher, of course. Could Mercado takes massive market share and could be trading at a much higher multiple? Of course. But all I'm trying to do is trying to guarantee myself at least some kind of a double over the next 5 years. And if I could just get this double, then I could see whatever happens and just hold on the stock and wait for the very long term. Because once you value stocks over the next 5 years, it's much easier not to overpay than if you value them over the next 10 or 15 or 20 years. And that's how I look at it. And that's why I decided to talk about Mercado and Celsius for the video. That was my opinion on them, not financial advice. I hope you enjoyed it. If you have any questions, ask me in the comments. Thank you again. If you did enjoy it, press the like button. Maybe consider subscribing, and I'll talk to you in another video.